Have you ever bought an investment, watch it rise, and when it's time to sell, you froze or even worse? Well, you're not alone. Most investors actually lose money due to the fact that they don't know the investments that they are holding. And that's the real trap. It's a real trap, right? That's the trap of not understanding the investment classifications. Welcome to the Eagles Eye View with Kamal Adeomi, and today we are breaking down the investment classifications, whether you are just starting or you're already building wealth. Is a topic that every investor must understand. It's a must for you to understand because it helps you to know where you are and where you ought to be and what to fit into your plan. All right, so let's just get right into the presentation. Now, this is why investment classification matters. And the first reason is financial planning. When you understand the kind of investments that you are going into, it helps you to plan well, right? The next reason is risk awareness. It helps you to know the kind of risk that you are getting into. And then the third reason is for smart decisions, right? It helps you to make smarter decisions. If you don't know the classification of investment or the kind of investment you are getting into, you will just invest blindly and you're just making decisions that are not smart. You're just making them. What is an investment? So let's start with an investment. For those of us that are new here, those of us that are not new, please stay with us. Let's go through this, right? Let's educate the people that are just joining us. What is an investment? And investment is an asset or an item that you acquire with the goal of generating income or appreciation. Just that's what an investment is. Anything that you buy that produces more money for you is an investment, right? You can look at investment as an asset. Anything that you buy that generates more money for you is an investment, right? So let's go to the purpose of investment. First purpose of investment is for wealth creation, right? Wealth creation. The second purpose is for financial security. You just want to build security around your finances. And then the third reason is for capital growth. So here are the major investment classifications, right? So now these are just, we are classifying them. By the time we classify them, we will now get into the strategy, right? So you have to understand the classification before you know how you inculcate them or embed them into your own strategy. So the first classification is real assets, and the second we have the financial assets, and the third we have the alternative assets. Now let's break down these assets into let's just do a breakdown of each of these assets. Now, the first one, which is real assets, we're talking about real estate. Anytime you hear real assets, we're talking about real estate, talking about land, housing, and commercial properties. Anything that just has to do with land and properties is a real estate, real assets, right? So the next is infrastructure. We're talking about road and energy projects. Just anything infrastructure that you can think of falls under real assets, right? The next is commodities. When we're talking about commodities, we're talking about gold, we're talking about oil, we're talking about agriculture, tradable commodities. And so, yes, that will lead us into the next one, which is financial assets. When we're talking about financial assets, we're talking about anything that has to do with money, stocks, right? Well, so let's just get in, right? So we're talking about equities, and anytime you hear about equity, once the moment you hear equity, we're talking about ownership. Equity talks about ownership, talking about stocks, shares, anything, just anything equity. When you hear equity, just know that we're talking about ownership, right? Which is stocks. We're also seeing what we call the fixed income. Now, what the fixed income is all about is that it's just your income is fixed. It doesn't matter what happens. When it's time, you get your reward at the time you ought to. And then we'll get into deeper explanation of that later in the video, right? We'll get a deeper explanation later in the video, but for now, let's just go through the classifications. Now, the next is cash and cash equivalents. We're talking about savings, money market, mutual funds, right? So now to the alternative investments. Alternative investments, we're looking at private equity and venture capital, private equity and venture capital, talking about investing in real businesses. Now you are owning a business, but you are investing in the business, not just in the share of the business. That's what where private equity and your venture capital comes in, right? So hedge funds and real estates, right? All these are alternative investments. You are investing but not directly, right? So, and next we are looking at cryptocurrencies and digital assets, NFTs and the likes, right? So the next is arts and collectibles. Arts, right? Just arts and things that you just buy and keep. These are assets. That there are people that invest heavily in these kinds of assets, right? So now let's go straight into the meat of the day. All the explanations previously are things you needed to know for you to get into this zone. Now let's get into the categorization based on asset class. Now the first asset class we mentioned earlier is equities and stock. When you're talking about equities and stock, you are talking about ownership in a company. A clear example of it is buying shares of Zenith Bank, or buying shares of GT Bank, then buying shares of Tesla, right? From either the New York Stock Exchange or the Nigerian Stock Exchange. Now that's an asset class, right? An asset class of equities I mentioned earlier. Anytime you hear equities, it's talking about ownership. The next asset class classification is fixed income, or you can also call them bonds, right? So this is an investment where you loan money to the government or to corporations, businesses, and after a period of time they give you back your money with interest, or they pay you interest. Now these interests are fixed. They are fixed. It doesn't matter what happens. They don't drop, they don't increase. Example, federal government savings bonds, right? When you are buying federal government savings bond, you get either 20%, 15%, 18%, and for the period of 2 years, 3 years, depending, right? After this period, you will get your money back, or you will get your your income or dividends, your coupons back at a particular time and at a particular rate. Now you can call this predictable assets, right? So the next is real estate. When we're talking about fiscal property investment, buying lands, buying buildings like that. So that's an asset class. Now the last one for asset class, right, is commodities, and we're talking about buying tangible goods with global value. Examples, we have gold, we have crude oil, we have cocoa, and I mean you can name it. Now let's get into the classification by risk profile. And we're talking about risk profile. We're talking about the level of risk that you as an investor can take. Now the first risk is low risk. The first is low risk, right? Now this, like the name goes, is low risk, is safe and is stable, right? It has stable returns, just like we mentioned earlier. It has stable returns. Federal government savings bonds, you get your payments, um you get your coupons quarterly, and once it's time you get it. It doesn't matter what happens. When you do commercial papers, the same thing. Once it's time, expiration time, you get your rewards back. Now this is low risk. They are predictable. They are time bound, right? You can actually predict them. Now let's get into the next one, or let's talk about the third one before we get into the second one. Now the third one is high risk. We're talking about potentially high. They have potentially high returns, right? But they are volatile. Think of this as investing in stocks. They can increase the value of your investment, can increase, and at the same time they can decrease, right? Now for stocks and bonds, sorry, for bonds and commercial papers, we are talking about low risk, right? It's just fixed. Your money does not increase, it does not reduce, right? But inflation touches your money at some point. But now, as against low risk, high risk investment increases. The value of your investment can increase and it can drop, right? Meanwhile, that of low risk, when you're doing for federal government savings bond, your money doesn't drop. So that is it for high risk and low risks, right? So now we get into medium risk. Medium risk is just a balance of the two. Now the next is by investment horizon, and we're talking about investment horizon. We are talking about time, the investment time. So we are looking at, number one, we are looking at short-term investments. Investments that are literally less than 3 years are referred to as short-term investments, right? Now there are some other classifications that classify short-term investments as less than 1 year, right? But on the general view, 3 years is the benchmark. An example of this classifications, we're looking at fixed deposit, we're looking at money market funds, right? Now medium term, 3 to 5 years, 3 to 7 years for medium term investment. Now again, there are some other classification that says from 1 year to 5 years is classified as medium term investment, and we're looking at real estate development projects. So if you want to get into maybe a real estate development project, you do that within the space of 1 to 5 years or 3 to 7 years, right? And there are certain bonds. Example, we have sukuk that take all the way up to 7 years, right? Even federal government savings bond. Okay, federal government savings bond, we have that of 2 years and that of 3 years. Now, long-term investments, anything from 7 years and above is referred to as long-term investment, and the goal for this is for wealth building, right? Now, again, like we mentioned, for medium term, there are some people that say it's between 1 to 5 years. So anything from above 5 years is referred to as, in that classification, long-term investment. Example, we have stocks. You buy stocks for the long term, because over time, when you stay with the company, the value increases and you get your rewards back. Now we are looking at pension funds. People who get into these kind of funds, they just, from their job or from their salary, they just keep investing for the sole aim of retirement, right? Index funds, same. Now the next is by liquidity, and this is where a whole lot of people are getting it wrong. Now, what is liquidity? Liquidity talks about the ease with which you are able to trade or to convert your assets into cash. You have an emergency and you have an asset. The ease with which you convert it or you sell it off to get back money to attend to that emergency is referred to as liquidity. So let's get into it. Number one, we have highly liquid investment, and when we're talking about highly liquid investment, it's very easy to convert. We're talking about stocks, we're talking about treasury bills, we're talking about money market instruments, right? Things that you can just easily go and sell from the comfort of your app, right? From the comfort of your phone, you can just easily go and sell stocks, right? Now the next is moderately liquid investment. Now these investments actually take time to sell, but they are not as fast as high liquid investments, but they take you time. Example, real estate, we're looking at corporate bonds, which is talking about commercial papers, right? Commercial papers, same as corporate bonds, right? So you actually sell it, but you don't sell it on time. This is moderate liquid or moderately liquid investments. So understanding this helps you to understand what you are getting into. So if you are buying stock, if you are looking to get into, say, you are looking to get into an investment and you may need the money maybe for rent, I wouldn't advise you to go and buy land, because when it's time for your rent, when it's time for you to pay your rent, you will start looking for who will buy the land. What if you don't get someone who is ready to buy the land at that moment, and then you need to pay your rent, or there's an emergency that you need to attend to, right? So understanding this helps you to know where to put in your money. And like we mentioned at the introduction or during the introduction, right, it helps you to fit each of these investments into your plan. And the last in this classification talks about illiquid investment. Now these guys are hard to sell, very difficult to sell, right? Without loss, if you are selling them, you may literally have to sell them at a lower price because you are trying to make sure that you sell it off. It's very difficult. Now we're talking about private business, right? You might think of it as a private business. It's very difficult for someone who is selling provision to sell off the business. It's actually very difficult. Now we are looking at collectibles. When we talk about collectibles, we're talking about arts and rare jewelries. Imagine someone getting an art or buying an artwork. When it's time for you to sell, it's not everybody that loves art, or it's not even everybody that invests so much in art. You hear some people buy arts with 1 million, 2 million, 10 million. I mean, for like 90% or 98% of the population think that that is waste of money, and so you would have to look for people that understand the value of the art before you can sell. And if you're in an emergency, you're definitely going to sell off at a loss, right? Now, so now, by source of return, so talking about the kind of return that the investment gives to you. Number one is income generating investment. And when we're talking about income generating investment, we're talking about investment that provide steady cash flow. Steady cash flow, talking about dividends, talking about rental properties, talking about bonds. Now, if you buy dividend stocks, right, what happens is at a particular time they send your dividends to you just for holding the stocks. Now, if you are holding a property, maybe you build a house for rent, or you have a mall, and there are different people collecting, I mean, the various space. What happens is at a particular time you get your money, whether you whether they like it or not. You just they pay you. And bonds pay quarterly, monthly, depends, right? So income generating investments, this is what they fall under. Now for the next, we are talking about capital appreciation. So this, you just hold them and the value of the investment increases. We're talking about stocks, we're talking about land, again, land banking, right? You just want to buy land, and after a period of time you sell it off. That it just increases in value. A hybrid investment talks about the investment that provide both income generating and capital appreciation. Example is blue chip stocks like Dangote Cement. So when you buy those kinds of stocks like Dangote Cement, Zenith Banks, your capital appreciates as the stock appreciates. But also at the same time, after a period of time, you get dividend. They pay dividends, right? So you are gaining from both ends just with one particular investment. Now the next is by the mode of investment, right? Now, by mode of investment, we are talking about direct investment. Direct investment talks about that the investor is managing the investment directly. So you're managing your investment directly. So talk about buying individual stock, buying a real estate, buying any property, buying an art. You are managing it directly. Now, what then? The next is indirect investment, there where um you buy through, I mean, where you invest through pooled vehicles, when we're talking about mutual funds, ETFs, and pension funds. This brings us to the end of this. Now I'm sure you have gotten value, and right now you know exactly where to put in your investments. Now, because of this, do well to hit the thumbs up, to like this video, hit the subscribe button, hit the notification bell, so that when I drop the next video, you'll be the first to be notified. Cheers.